Hello, everyone. Thank you for joining us for today's Dorsey Wright podcast. My name is Ben Jones, and I'm here with Steve Raymond. Steve, it certainly was a tough quarter for Q1 2020. I believe it was, probably the worst quarter, first quarter I think for the market ever. When you look at a lot of the data and some of the hyperbole that have come out surrounding this data. If you look at just the Dow Jones in general, which is often used as a primary benchmark for the industrial strength of the market, it's used alongside as a performance benchmark against the S&P 100 and the Nasdaq Composite. But if you think about the Dow, and this is the index that you often hear on NPR being quoted, it was down about 23.2% last quarter in Q1 2020. It's the worst performance that we've seen for this index since the fourth quarter of 1987, and it was the worst first quarter ever for the Dow. So that was certainly tough. A lot of this underperformance really occurred in March, and if you think about the S&P, it was down about 0.5% in the month of March. Worst month since October 2008. So again, you're looking at periods in the market that we're being compared to, and we've talked about it a lot on this podcast and in the Daily Equity Report. October 2008 comes to mind, October 1987, volatility like the late 1920s. So it was certainly a tough period in equity markets, Steve, and we've seen a lot of our indicators and a lot of our rankings react because of that.
Yeah, you sure do. And I'd like to add that in the modern era, the 401k participants are also in this game, in the 20s and the 30s, 40s, 50s, not so much. But here I think everyone's involved. And if you look at the fast 15-day descent, maybe the fastest on record, my guess in summing up what 401k participants actually owned, you buy a handful of funds and you're sitting there with a handful of funds. You're down 28% at the low, and you're down about 20% and a half on average as we speak. And so I think that the speed of being down 20% and counting yourself lucky, I might add, is really woken up, a lot of people that are in the periphery of the market. Especially accessing the market through the 401k. So, everybody's in the game, not only in the institutions, but the, bank trust and those professional folks, but, the retail and us and, everyone else out here getting to be amazed by how the market moves as well. But, as we've been talking over the weeks, to bring people up to speed, there was a passionate sell-off low back, near the 23rd of March. Since then, we've been building up some bases, trying to see if the indicators are building up a cause for, to see if demand's coming back into some charts. We've actually done several broadcasts, podcasts, webinars, on these subjects. So please stay involved. As we, go through these periods of time. I will, remind us all that when we go into negative markets, the correlations of negative markets, as people often say, cause everything to drop at once. And that is true. But I'd also like to mention another dimension that is not mentioned often, which is that these signals cluster close together chronologically, meaning that if we're in a period of distress, it could be immediately followed by, a robust rally that might last for, some short period of time, and then you're back to wondering if you're, need to be defensive again. So we call this signal clustering, and so you have to get used to the idea that the story, could change from week to week. We don't want to hope that stories change week to week, but you're in those periods of time where you kind of have to be in the game to manage the account and possibly, seen fit through indications or models you follow or whatever else you're doing in your shops. To be able to make those adjustments that you deem necessary, in a relevant period of time, addressing the market.
Yeah, you're absolutely right. Right. You see volatility cluster, where you see some of the best days of the market are often surrounded by some of the worst days. And that's what we saw in that stretch, kind of right around, St. Patrick's Day in March and the week of the 23rd. If we look at, what has been working, Steve, pulled up the, group score return report, which is, available, through the asset class group scores page. And, what you've put together, through this tool is kind of showing you average returns for these different categories and ignoring, inverse equities, which is the best performing, in Q1. You did see some, positive absolute performance from, U.S. fixed income quality, right? That was a quote unquote a safe haven, last quarter. Money market certainly was, roughly flat. We did see, on average, a lot of like municipal bond funds and just general bond funds perform well on a relative basis. Managed futures is a group that performed well on a relative basis and, did what it was supposed to do, provided, some, diversification during this period, even after, 5 years of lagging as a group. What really is surprising, Steve, is just how hard certain equity groups were hit last quarter. U.S. small cap is a great example. I think the average U.S. small cap fund with active passive in this group was down about 31%. Real estate struggled, down about 26. Emerging markets struggled, down about 25. So, really there wasn't a lot of areas to hide within U.S. equities, and you really had to, be tactical and provide and allocate to some defensive exposure, whether it's fixed income or cash, to really, miss out on the brunt of the move last quarter.
Yeah, one thing to keep in mind, as professionals are gathering around and coming up with their game plan, following their game plan, is sometimes the market gets hit and we're in the best places because the relative strength method, puts us in relative leadership. I think this is one of those times where, coming into this market turbulence period, large growth and a larger cap with mid growth and some things of that nature, we're in leadership, clear defined leadership. They remain so today. Actually, according to macro or a style box analysis, large growth is still the leader. What's also important to say is that small cap, small value, some of those small cap tranches that got hit so ferociously were also the laggards and the low relative strength signals coming into the event, before the event, the negative event occurred. So the idea is that by keeping relative strength higher, we can do better even in turbulent times. And I think that the small cap, deviation on its return profile, does match that it came into this period as a laggard anyway. And so it kind of is helpful to remind oneself that there are a lot of areas, as Ben just mentioned, that got sizzled on this move into a turbulent negative trending market. But the better survivors of that statement, are the relative strength leaders coming into the month in the first place. So, there are benefits of sticking with the relative strength game plan and making sure that we keep our eye on who the leaders are. Yes, I do recall some bear markets where relative strength leadership changes. And of course, that's something that we have to monitor, I think, daily, weekly, to keep an eye out for, those preferences that the market will show. I would say that so far there's no internal equity relative strength shift, meaning that the equity portion that we held coming into March is still the leadership that we're following here. However, you could take a couple steps back and say, yeah, but fixed income got stronger, and I think you're right on that. The fixed income part of the allocation is always an important one. Over the last few years, many have said that fixed income would not play a vital role in asset allocation and probably would be, carrying a negative along the way. But as this market proved, fixed income rose to the challenge in a fabulous way. I'll give you a case in point. We have FSM models, as many of you are following, and most of those models did not change on this end of month period for two reasons. One, it's not a scheduled change date for a reallocation, and two, there weren't enough defensive indications that those FSM models follow to switch from offense to defense. So basically, most models are unchanged moving into April. However, we do have one. It was the American Funds monthly model. It's a top 5 model. Many of you know. Many of you do follow a FSM-related American Funds model. This is one of those handful of American Fund models that we've had for a while, and it did make a change. The net result of the change from the beginning of March to here, the beginning of April, is now we see we have 3 bond funds, 1 equity fund, and then a fund in the middle, Balanced Fund of America, which is generally tries to stay at a 60-40 equity fixed income relationship. And so what's interesting about that total net change to that portfolio is it's riding around a 30-35 equity to 70-65 fixed income mix. You could say for even numbers purposes 30-70, and it gives you an idea that in that American Funds kind of culture that we like to deal with, the mix is now more dialed down, a little more conservative, with only 30% of the equity on the field, and then the rest of it working in some different fixed income tranches. So again, that was one model change. That was not the predominant thing we saw. We're still waiting for the end of April or in the May timeframe for another reload on all those wonderful funds inside that model. But it does cause you pause to say, hey, maybe I ought to look at this model and see how this pertains to what I'm doing. Maybe it serves as an example to help pave the way as a guiding light to different ways to approach the market. As the advisor is trying to adapt, to these what I would call bearish market times.
Yeah, I mean it's spot on, right? Where we have seen some rotation in some of the models. You've seen rotation, from an asset allocation standpoint in Dolly. Definitely want to hit upon the concept that those leaders, especially within U.S. equities, underneath the surface, coming into this correction, remain the leaders today. Steve, you mentioned large growth. And something also that I think is interesting is just the broader S&P 500, Steve. When you think about, the core U.S. market, and this is something that, you track closely, the S&P 500 index group is still ranked above, 78% of all other groups on the system right now. What does this mean, for U.S. equities right now, Steve?
Well, it's kind of one of those important paradigms that, we and you, the advisor, need to, continually monitor. It's like monitoring health in a market or health in a specific market type. Having a robust and strong S&P 500, or you could say core equity component of the markets, is very vital to understand if we have that or if we don't. If we do have that, what it tends to suggest is that most of our allocations in the equity space continue to center around the S&P 500 and more larger cap in nature. It tends to reinforce a U.S. dominance also. That's a good guiding light. That's a good lighthouse. As we're out there trying to get to shore, we need to know if that harbor is the one we're going to park in. And right now, the S&P 500 is running around the 80th percentile, meaning it's as strong as or stronger than 80% of the other asset tranches around the world. It also gives us an insight as to how we should form our allocation, as I just mentioned, which is maybe core-centric, larger cap and centricity. and that gives us, something to, to work with. I will point out that there are many bear markets in the past, half, let's say, where the core is not as vibrant or vital or strong, and that tells us, if we see that we need to look elsewhere. As simple as that sounds, we'd have to go and do things that are a little harder to do. Like, for example, we'd have to call up, Mr. and Mrs. Client and say, hey, we're going to go into some maybe small caps or non-U.S. regions and park a lot of money in Asia or somewhere. And those are always tougher phone calls because it's kind of, outside of the modern portfolio genre that many of us and many firms, are well aware of what that means. So, it could be that, down the road we have to look for, relative strength leaders that are not the U.S. core. But I think at this point we can confidently say that, up to now, today, at this part in the timeline, the U.S. core is holding in very well. In fact, better than many people suspected it would. And I think this is key evidence to say, yes, on the one hand, we're in distress. Yes, on the other hand, we're using some more fixed income. And yes, we're still sticking with that core equity block through these turbulent times based on its dominance and strength in the equity relative relationship.
I think it's spot on. So, Steve, you had two questions. These are questions that we get from the field, and I know you're talking to advisors, on a daily, probably if not hourly basis these days. But we get the questions of, what to look out for, for a recovery, right? When do we know if you're in cash right now? What indicators or what rankings should they focus on? See, hey, if we're going to see a material improvement for U.S. equities going forward. The second one is, how do we know if this is going to be another leg down, right? What if this gets worse? What do I need to pay attention to? Oftentimes, with the when to buy type questions, kind of pointing towards, changing the relative strength rankings and seeing group scores, or you look at the indicators like the New York Stock Exchange high-low. What are some indicators that you're looking out for, hey, if we see a material improvement or if we found a bottom?
Well, I think there is a list of indicators. I think we put them in the report quite often, daily. Sometimes I focus on fund-generated indicators, meaning indicators that follow mutual funds and ETFs, making sure that their voice is heard too, because we do a lot of writing on the stock indicators. But I think that some of those are well known. Right now, I think we remain to the PT type charts, Papa Tango, like a PT NYSE, a PT MU0, some indicators that watch both stocks, and in the case of the PT MU0, watch equity funds. We'd like to see some reversals up in those areas. Some bear markets require two reversals up. Some require one. If I could toss a coin, the faster you drop, typically means that we might only require one reversal up. Sometimes when you expand the pain over months and months and months, sometimes it takes two. But the real answer to the question is we don't know. We just have to look for the indications to start to strengthen. I can say that I don't see positive trend indicators strengthening here. So that might divert us back to maybe a shorter term view, which would be, if you look at the S&P 500 in the futures, I tend to look at both. It's the same thing in essence. The point, the point values are slightly off, but from each other. But I think 2,400 to 2,450 is a very good support area. The 24 to 2,500-ish area is what we've been hovering over the last 2 days, and I think it's you could call it a key support, a helpful support, and to me, I think the market's demonstrated over the last two nights that it's definitely trying to hold those levels. I would like it to see it hold those levels, and a breach below the 2450 or 2400 lines would be somewhat alarming. That we have to now watch out for, is there a price back to the passion low of a week or so ago. But in essence, you have a good shot that it's trying to hold this area here. In the management of the trade, I think you do look at the short-term support lines. You could even go to point and figure charts. You could look at the next stop loss, as our advisors are trained to do, and kind of meditate where those points are on your fund, on your stock. But again, the market overall is very well near the area that I think is a key support level. That's good news that we're talking while it's above it, and that would need to be monitored. So I think that you could say that it might be a little too soon to hope that the PT charts are going to reverse up, this week. But you don't know. So that's why you have to relog on and let's monitor that situation. And then in the shorter run, looking for the market, the S&P to hold the 2,400 through 2,450-ish price zones, I think is very helpful to see that occur. And what you find in a core-centric market, and which ties back to a comment I made earlier, is when the core market has readings up near 80, 70s and 80s and 90s that we referenced earlier. It tends to mean the S&P 500 has a lot of control. So just watching the S&P 500 itself tends to translate, answers that you might have on other funds of different kinds. So I think that it makes it simple that we can watch, an index or two and a couple indicators and get some good explanation on where we are. And that also, gives us a current status, but also gives us a guiding light of how we're, what changes that we may see that will tell us to make, the other adaptive moves. Now, I was going to ask Ben a question here, but, for now, FSM models are not going to make a change until the next point of checking in for an FSM model will be at the end of April. We do have a portfolio I'll let Ben talk about in the FSM genre that will look sooner than that. And then there are other models that, that Dorsey Wright runs through April that have different check-in points. But in classic FSM, the next scheduled check-in is at the end of April. So, what that could mean is that the advisor, the professional says, okay, I hear you, Steve. Now, what I'll put my hand on the wheel and check in daily and make sure that we're, paying attention to the relevant market action, or in some cases, news-driven action. But really, the indicator, where are the indications? What are they saying? In case you have to grab the wheel intra-month. But Ben, so there are some different versions of models that Dorsey Wright does. I mentioned FSM's next check-in point is at the end of April. Do you mind pointing out some other options people have?
Sure. Yeah. So if you go to the models page for those that subscribers, and if you're sign up for a trial, whether you stumble upon us through an internet search or word of mouth through a financial advisor, sign up for a trial, go to the models page, and subscribers, you'll be able to see all these models listed. If you subscribe to the ESS package, you get some additional models that are built off of some of the team builder concepts and matrix concepts. But overall, Steve, we have models that update daily, we have models that update weekly, we have models that update monthly, and of course, your seasonal quarter models that are FSM based. A lot of the weekly models are reviewed for a lot of our ETF providers. Doesn't mean that you see a change every week. So we have seen some rotation in a lot of these weekly models as they adjust. Some of them kind of either adding risk off positions, such as fixed income, or shedding those away based off of some of the rallies that we've seen in equities. If you look at the daily models, they're typically going to be individual stock based. So those are ones to pay attention to. Again, it doesn't mean that you see a change every day, but it's just a sensitivity. We did see a change in one of our monthly models, which is stock based. That's the blue chip growth. That's a model that basically pulls from a large cap universe. We recently saw Walmart rotate into this particular model. which I think is, an interesting trade in the sense that it's kind of going towards consumer, staples / retail in a way. That's one to pay attention to. And then, of course, we do have some models that drive some, index-based products or active ETF-based products. They're based typically on the models on the system. However, there's sometimes delays when the index are updated, or we might use a more sensitive indicator. Some of our recent, FSM-based products that are advisor shares, look at some indicators and they look at it weekly. Those have not triggered yet, so they're still, fully invested. So that's, something to pay attention to. I think the key, though, Steve, if we look about all this, it's all about diversification, right? It's diversifying, and building kind of an ensemble of strategies or sleeves that might adjust the markets in different ways, and have the ability to either rotate into equities or out of equities. Maybe they might not do it all together at once, and so we put together kind of an interesting basket of funds in the ETF spotlight today, where you're basically buying, let's say 5 single CUSIP products, or excuse me, 6 single CUSIP products. And they all have varying degrees of cash exposure. And this is looking at the Victory Shares lineup. This is looking at Pacer, Advisor Shares, First Trust. They've all gone defensive. They've gone defensive at, to different degrees. So I think that's interesting for those advisors that are looking for kind of dynamic strategies that can be defensive, that can also rotate back into equities, especially for those that are, looking for methods of and process of when to buy and when to sell. Definitely want to explore those products, but that's just something to pay attention to. It's not only the models on the system, but also some of the ETF products that are out there for investors.
Yeah, I've had multiple conversations over the month, and I just want to say in general that I'd like to, and this is going to sound a little strange, I give the advisor permission to make adjustments that they think bring the allocation back into the risk tolerance of the client. Now, I'm a little facetious when I say I give permission, but it's okay. I mean, it's okay to say, hey, I need to get my allocation back in line with risk tolerances. Maybe that means I'm buying more equity. Maybe it means I'm raising more fixed income. And I think it's okay to make minor adjustments to make sure that, your best ideas and the client's, tolerances are being observed. I think that's okay. What I often say is that's okay to make adjustments intra-period, but do you have a plan to get back to offense? Do you have a plan to raise more defense? Do you know how to make the next step after you make let's say, a temporary adjustment? So, keep that in mind. And often, again, we've stressed the equity side of the market on this call. I'd like to go back and mention a little bit about fixed income, because I do think fixed income is an important part of the allocation. The American Funds model I mentioned earlier suggests that fixed income is important, and I think it will remain important. For those that sometimes a new crisis causes us to forget the prior crisis. But remember that in 2018 we had a relative strength failure in a lot of fixed income. In fact, fixed income began what I would call, if you call the correction or bearish action in 2018, where the fixed income falling apart was kind of odd, and led to a high money market percentile rank in the 2018 episode. This episode in 2020 is very different. The fixed income is holding in outstandingly, and for those reasons, part and parcel of those reasons, have kept the money market indications rather relatively lower than in 2018. But to get to my point, I think that what type of fixed income we do is also important. I'll give an example. In the American Funds lineup, the monthly lineup, that fixed income selection is going to be U.S. government securities, mortgage, and Bond Fund of America, which is classically an actively managed, low volatility, and in some sense aggregate of the bond market. And I think those are nice spots to think about. On another side of the coin, the Franklin fixed income monthly model made some changes also. And many of you that know me know that I really do like Franklin's shop and the fixed income desk, and think that they do a good job. In their lineup, they have two funds. It's the U.S. government securities, that's still there, and then the high yield tax free, which is really, suggestive of that the munis are still doing well. And I think that's important because the municipal market's very important to, I think, most of us economically, but certainly the high net worth investing, your clients, high net worth individuals, using municipals is a very big key. So the Franklin does have a iteration of municipal, and in this case municipal high yield, so a little bit more aggressive municipal, but I think relatively high quality. So that gives you some ideas of where that fixed income mix should be. In some sense, U.S. government securities, in kind of right parallel with that, in some sense, the mortgage market, and then the high yield market. And so what I didn't mention was emerging market debt. What I didn't mention was convertibles. What I did, there are some things I didn't mention. What I'm mentioning is kind of beefing up the quality of that fixed income tranche, in some sense aggregated around, the U.S. government short-term duration funds. So I think that, again, as you're contemplating or making adjustments, and the idea of mentioned to both sides, equity and fixed income is important. And so keep up on the research on those points of view. Again, the law not really involved in these asset selections in fixed income that I mentioned. It's more so a little bit lower duration, a little bit of mortgage, a little bit of tax-free, kind of that simple mix, is where the scores are pointing to. So I just want to encourage you to, when you look at an allocation, there's more than one subject. Typically, it's not just what do I do with my equity. I think it's more what you do with the whole allocation.
Yeah, I mean, you're absolutely right. And, users, can track that through asset class group scores or Dolly, or, even through the ways that allocation is expressed in the various models. We mentioned equities, we mentioned fixed income. We have not mentioned commodities. Those, most investments are still, ranked at the very bottom of a lot of our rankings. And just look at being primarily led by just weakness in, energy, right? Precious metals have held up within the commodity space, but not enough to really keep the asset class in a favored position. So you still need to be selective, within some asset classes like commodities. Currencies held up because of the U.S. dollar, as well as just on a pure relative performance basis, where you weren't seeing currencies experiencing the massive downshift that we saw from equities and commodities. But again, we track all these asset classes on the Dorsey Wright research platform. Whether you're looking for charts, whether you're looking for indicators, whether you're looking for models, or whether you're looking for a process, I think we have something you can use. Go to dorseyWright.com, sign up for a trial, or just give us a call, and you can learn more at 804-320-8511. I'd be happy to have that conversation with you. Steve, thank you so much for joining us today on April 1st, or April Fool's. We recorded this, but I hope everyone has a great day, great week. Stay safe, stay healthy, and take care.